Welcome, everyone. If you've ever watched the evening news, seen absolute geopolitical chaos unfolding, and then checked your portfolio only to see the stock market breaking record highs, you've probably thought to yourself, wait, how is this even possible? It feels totally disconnected from reality, right? Well, today's explainer tackles exactly that. We're going to look way past the mainstream headlines and dig directly into the data to uncover the completely paradoxical nature of modern stock market rallies during global crises. Okay, let's dive into this massive mystery. We're going back to April 2024. Geopolitical tensions were just soaring globally, yet an announced ceasefire triggered this sudden, immediate market rip. But here's the real kicker. That huge rally sustained itself even as the ceasefire immediately began falling apart in real time. Traditional financial media rushed out to call it a relief rally, basically suggesting the market was just celebrating world peace. But as you'll see, the underlying data tells a vastly different, far more mechanical story. Let's look at the timeline to really set the scene here. On February 28th, we had joint U.S. and Israeli airstrikes in Iran, and the Strait of Hormuz was essentially shut down. By late March, the S&P had dropped nearly 9%. That was literally the worst 5-week losing streak the market had seen in almost 4 years. Then, on the evening of April 7th, a ceasefire is announced. The very next morning, the market violently reverses. We're talking about the Dow climbing over 1,300 points overnight, its best day in almost a year. But to truly understand why this flip was so violent, we need to see what was happening right before it. Because behind the scenes, Goldman Sachs was tracking a completely different reality. Goldman runs a prime brokerage desk, which basically means they service the major hedge funds and can see exactly what all that institutional money is doing. So while traditional media was painting this picture of a calm, logical relief rally, Goldman's data showed that heavily leveraged hedge funds were absolutely panicking beneath the surface. Institutional money was dangerously overleveraged and betting heavily against the market going into this whole geopolitical event. Hedge funds were selling at the fastest pace in 13 years. This was the largest North American hedge fund selling spree since the pandemic crash back in April 2020. Gross leverage was sitting at over 300%, which is just staggering. That's near an all-time high. And short exposure to major macro ETFs like the SPY and QQQ, that had hit pandemic-era highs too. Wall Street was heavily positioned for a crash. And this quote brilliantly illustrates the genuine fear gripping the street at that exact time. Commodity analyst Rory Johnston noted in mid-March that analysts weren't just casually bearish. They were preparing for a catastrophic global economic shock. They were actually modeling scenarios where 15 million barrels a day of global demand would need to be shed. That could potentially drive Brent crude to $250 or even $300 a barrel. As he bluntly put it, recession is too late a term, we're talking depressionary. Everyone on the street was terrified. Okay, so everyone is braced for a depression and they're heavily shorting the market. Then, the April 7th ceasefire drops and the market explodes upward. While the mainstream media narrative claimed April 8th was simply a celebration of world peace, impartial AI satellite data from a maritime intelligence firm called Windward tells a totally different story. They track digital GPS signals and satellite radar of the physical ships actually moving through the Strait of Hormuz. And what did they find? That maritime intelligence detected only 5 outbound carriers moving through the strait by midday on April 8th. That is a massive 96% decrease in activity compared to the pre-conflict baseline of about 130 daily transits. So the ships simply weren't moving. The physical reality of the conflict had absolutely not resolved. Which brings us to an absolutely crucial question. If hard physical satellite data proves the geopolitical situation hadn't actually improved, what on earth caused over 400 names in the S&P to suddenly finish green that day? If it wasn't peace, what was it? Well, the true culprit was a good old-fashioned short squeeze. This was essentially the first of 3 massive dominoes to fall in a completely mechanical chain reaction. Remember how we just talked about short exposure being at pandemic highs? Just as a quick refresher, when you short a stock, you borrow shares to sell them, hoping to buy them back much cheaper later. But if the price unexpectedly goes up instead, you are in serious trouble. Let's break down how the squeeze builds in real time. First, those highly leveraged hedge funds short the market. Then, the ceasefire headline causes an unexpected brief little price bump. In response to that bump, brokers look at that crazy 300% leverage and immediately issue margin calls. To cover those calls, the funds are completely forced to buy back shares at a loss. And finally, all that forced, frantic buying pushes the price up even further, which triggers even more margin calls. It's this vicious cycle of buying that has absolutely nothing to do with global peace or company fundamentals. So once that first short squeeze domino fell and prices spiked, It triggered domino number 2, the algorithms, specifically the CTAs or commodity trading advisors. These are massive systematic trading firms that run entirely on rules-based, mechanical, trend-following models. They don't watch the evening news, they don't care about geopolitics or the Strait of Hormuz. They are purely following mathematical trends. Going into the ceasefire, these CTAs were sitting on about a $30 billion net short position. But that initial short squeeze pushed the S&P across certain hard algorithmic trigger levels. Goldman Sachs data revealed that these mechanical models hit their limits and were mechanically forced to aggressively flip from short to long. They ended up automatically buying an astonishing $86 billion in equities in just 5 trading sessions. That was driven entirely by code, literally one of the top 5 fastest buying prints of all time. And that brings us to the third and final domino to fall, the options market. A data platform called Spot Gamma had actually flagged a negative gamma regime heading into the ceasefire event. Now, negative gamma is essentially a state where market mechanics get truly wild and become completely detached from human decision-making. Think about how this hedging loop works. When customers see the market ripping upwards, they pile into call options, basically betting the market will go even higher. But the dealers who sell those options are required to remain delta neutral, meaning they can't take on the directional risk of the market going up or down. So, to hedge their bets, as the price goes up, those dealers are mechanically forced to buy the underlying stock. This creates a massive pro-cyclical feedback loop. The algorithms push the price up, options dealers are forced to buy more stock to hedge, which pushes the price up more, forcing them to buy even more stock. And here is the truly fascinating part. We've actually seen this exact mechanical movie play out before, across completely different timelines. Back in December 2018, the market was crashing. Fed Chair Jerome Powell literally just said the word patient, and the Dow exploded over 1,000 points. In August 2024, the Bank of Japan hiked rates, the Nikkei crashed 12%, and then instantly bounced 10% the very next day. And, of course, our April 2024 ceasefire squeeze. These are completely different geopolitical catalysts, sure, but they trigger the exact same underlying market mechanics. The reason this keeps happening is deeply structural. The stock market we used to know, the one with humans modeling cash flows and valuing companies, is basically gone. Today, 63% of all U.S. stock funds is held by passive indexers. That's over $13 trillion of blind money just sitting on autopilot. It receives allocation on default, meaning it buys stocks simply because they are in the index. It completely ignores earnings, valuations, or global events. So what about the remaining 37% of active investors? Well, that industry has seen some massive consolidation. It's now dominated by giant multi-strategy funds like Millennium, Citadel, and Point72, and they are running with an incredible 4 to 8 times leverage. Because of that extreme leverage, they aren't sitting in conference rooms debating geopolitical realities when the market moves against them. They are governed by super strict algorithmic drawdown rules. If a loss limit is hit, they automatically liquidate. Period. Layered right underneath all of this structural change is an options market operating at just breakneck speeds. Astonishingly, same-day expiration options, known as 0DTE, now make up about 63% of daily S&P trading volume. Notice how that perfectly mirrors the passive investing figure? The market is increasingly dominated by these trades that last only a few hours. Because of this massive short-term options volume, on peak days, over $2 trillion of notional value changes hands in a single trading session. $2 trillion. And every single one of those trades forces a dealer on the other side to hedge their books in real time, mechanically buying and selling the underlying stock, the very stock that sits in your retirement accounts, just to stay balanced. To summarize our explainer today, the market is essentially a machine now. We have passive funds allocating trillions on default. We have giant hedge funds and CTAs reacting mechanically to price movements. We have options dealers absolutely forced to hedge in real time. Traditional fundamentals and geopolitical realities have largely been replaced by giant feedback loops of machines reacting to other machines. That April rally wasn't about peace at all. It was a short squeeze colliding with algorithms and option dealers. So as we wrap up, I want to leave you with this provocative thought. If the daily financial headlines, the ones shouting, "Markets celebrate peace," are really just convenient narratives used to rationalize complex algorithmic trading loops, when the next major crisis hits, will you just look at the news, or will you look for the mechanics beneath the surface? Thanks for tuning into this explainer. Keep learning, and I'll catch you in the next one.